Phil Chronican, welcome to the programme.
Thank you.
Well, I'm going to be a Cassandra today. What do you make of this quite slight change of heart of some of our property analysts very recently, and also JP Morgan reducing Australian banks from overweight to underweight last week, at least partly because of housing risk?
Look, I think the market's likely to be soft, and what I've been trying to point out is that the days of house prices doubling and redoubling are probably over for some time. But I don't see the house price collapse as anything in a realistic prospect. It's just going to be a period of soft growth in housing or relatively flat prices.
Do you think that the Australian banking sector is too exposed to the housing market?
I don't think it's too exposed, but it grew a lot over the last 20 years, and I think getting some rebalancing in the business back to other parts of banking is a healthy thing.
I mean, it's dramatic, isn't it? It used to be a third of lending with two-thirds business. Now it's basically the other way around, isn't it?
It is nearly the other way around, and I think one of the things that we need to look at is rebalancing it so that business banking, good old-fashioned commercial banking, is a much more important part of our business.
Let's talk about the impact on the banks of this. $1 trillion in mortgages now we have sitting in the banking sector in March, we're told. Do you think banks are a play on houses now?
Well, I think, as you say, the books have become two-thirds housing, and it is time for that to be redressed, and getting a more balanced portfolio, I think, would make banks more of a play on the economy, which is where most investors tend to think the banks typically fit.
The tricky thing is, though, how do you then do that? Because business loan growth certainly won't fill the gap if you're trying to get it back to reverse it to where it was.
Well, not in the short term it won't. But I think one of the things we saw when the national accounts figures came out this week is that business investment is one of the few bright spots in the economy. So in a period when exports fell because of the floods, we did see the beginning of the business investment cycle. So I think there is that opportunity for, over time anyway, for the business to play a bigger part.
But again, I'm talking about the relative size. Your mortgage credit growth at 15% drove your revenue growth, didn't it, until about 2 years ago. Now we've got that credit growth at 6.6%, more slowly than in 30 years. Effectively, hundreds of millions of dollars lost in the banking sector.
Well, I think that's the reality that we're facing. We're not going to see home loan credit grow at 15 to 20% a year like we saw in many periods in the last 15 to 20 years. So, A, we need to get used to lower rates of growth generally, but B, put more of it back into other elements of the banking package rather than just writing mortgages.
Now, if credit growth is down, how do you keep price growth up?
Well, I'm not sure, and what I've been trying to say is that keeping price growth up shouldn't be an objective in itself. I think we've already got affordability issues in the Australian housing market. Australian house prices are high on any absolute measure, and I think that a period of subdued price growth is not a bad thing for the economy. I don't think we're going to have a collapse because the demand for housing remains strong. Indeed, most analysts think there's a shortage of housing. But I do think it's a period when a couple of years of moderate house price growth or stable house prices is not going to be a bad thing.
So you're quite confident about the supply side, but again, elsewhere in the world, Britain, for example, that wasn't an issue either, and yet there was a big property crash there.
Well, there was a massive decline in demand there and big, massive uplift in unemployment. I think if anything, the problem in Australia is the opposite, which is that we've had a shortage of supply. And, one of the things that I think we need to be looking at is if we want to get house prices in the longer run to stay affordable in the face of population growth, we're going to have to look at the supply.
The investment market, though, you do think is potentially slightly more wobbly, don't you?
Well, I think that rental yields, which is a good proxy for the attractiveness of the investment, have got to a pretty low level. So, either prices have to stay soft for a while or rentals have to rise or some combination of both before that makes sense again.
By the way, you mentioned negative gearing in your speech. You said the government may want to consider negative gearing, tax breaks, may be an unhealthy focus. Isn't that a bit rich, given that you guys have made an enormous amount of money through negative gearing?
The point I tried to make was, and it's the risk factor of it, I think that negative gearing is oversold to many people. I'm not saying there's anything wrong with negative gearing as an element of tax policy. What I am concerned about, though, is that some people have become obsessed with negative gearing and seem to have forgotten that the word negative is in it. That to get the negative gearing tax benefit, you had to have negative cash flows. And for a lot of investors, I think they underestimate just how expensive those negative cash flows will be.
But can you see it's a bit ironic, given
Look,
how much
it's been part of our business, and I appreciate that.
Yeah. So, all right. Well, if that comes along as well, then you've got that knocking your growth too. But on the other hand, you've got household debt, which is enormous. And I see that the Westpac data anyway recently shows that arrears are on the rise. Recent spike in mortgage arrears, that's 90 days delinquent, are now at their highest level for 15 years. Personal loans, the highest since 1996. And you still don't think there's any chance of a slide in property?
Oh, I think, as I said, I think property prices will be soft, and I think
what's the difference between soft and a slide?
Well, I think if you've lived in Sydney for the last 10 years, you'd probably know what soft is, which is house prices have not moved much at all in the Sydney metro market, other than for 1 year when they were booming in Perth and other centres. And I think nationally we're likely to see soft prices. So, but coming back to that point about mortgage arrears going up, I mean the issue is affordability. Houses have got expensive. And I think households are struggling at that, meeting the rising interest rates and the high prices, which is why I do think we're in for a period of pretty subdued house price rises for a number of years.
Coming back to the banks itself, UBS yesterday warned of a pig in the python for 2009 mortgage arrears. That was the time, of course, of the first homeowners grant. Now, the UBS says that if rates continue to rise, they see a possible mortgage arrear figure of around $13 billion by 2012. That's next year.
Yeah, I think that's a pretty extreme view. I don't think that's where we're seeing it. We have seen the rise. Part of that rise has been transitory with the issues in Queensland around floods and so on. But part of it is just that affordability issue starting to hit at the mortgage belt. But we think generally Australian households are in reasonably good shape. We've seen huge growth in household savings over the last couple of years as well. So the household sector, I think, in many ways is self-correcting for the issues that it's had.
But if that happens, if arrears do go up like that, then you'll have to be looking at tightening of credit, and that's that deadly balance, isn't it, for you guys?
Oh, it is, and it is a balance. And I think really the point I've been trying to make is that it's a time for thinking about a period of stability for these things to work out. That's the best way we can avoid a crash.
Mike Smith, when I spoke to him last, ruled out a further tightening of credit in the near term. Is that still ANZ's position?
Absolutely. We're in a market at the moment where many people are loosening credit standards. We don't think that's appropriate. We think that this is a time for conservative lending. And when you're in banking, you've got to be thinking about the way these issues unfold over the next 3, 5, 10 years. And we just think that this is a time for sound credit standards and a sensible approach to the market. And otherwise, we could have the sort of crash that we've seen in the US or UK.
In the meantime, I see ANZ loan originations in the last little while seem to be lower than the other three. Is there any reason for that?
Well, we were pretty strong last year. We grew over ahead of the rest of the market for most of calendar 2010. Fell behind a little bit over February, March, but it's not something we would see as a lasting issue. We would expect to be in and around the market for most of the year.
So I, Cassandra, have failed to convince you about an imminent property crash?
No, I don't think there's an imminent crash, but I think if we had kept going with the sort of double-digit credit growth and double-digit price growth for another few years, we would have been at risk.
Phil Chronican, I thank you very much for coming in and joining us.
Thank you, Tikki.